All right, let's talk about something super important in your insurance policy that honestly a lot of people overlook. It's called the aggregate limit. And if you don't understand it, it could leave you in a really tough spot. So let's break down exactly what it is and why you absolutely need to know about it. Just think about this for a second. Imagine you've had a rough year for your business. A couple of things have gone wrong, but you're thinking, hey, it's okay, my policy is still active. But what if that safety net, the one you're paying for, could just disappear? Even when you still have months left on your policy term? It can happen. Okay, so the best way to get your head around this is to stop thinking of your insurance as some kind of magical, unlimited shield. Instead, I want you to picture it as a bucket of money. Your insurer fills it up once at the very start of your policy year, and every single time you make a claim, a little bit of that money gets scooped out. To really understand how protected you are, or aren't, you've got to know about two different types of limits in your policy. They sound kind of similar, but trust me, they do very, very different things. Let's get into it. First up, we've got the aggregate limit. This is the big one. It's the total, absolute maximum amount of money your insurance company will pay out for all of your claims put together during your entire policy period, which is usually a year. This number, this is the total size of your bucket. So what's the difference and why does it matter? Well, your per claim limit is the max your insurer will pay for one single event, but the aggregate limit is the grand total they'll pay for all events for the whole year. You can have a huge per claim limit, but it means nothing if a few claims completely drain your aggregate limit for the year. Theory is one thing, but let's make this real. I'm going to walk you through a quick story so you can actually see just how frighteningly fast that bucket of money can empty out. Okay, let's say you run a business and you've got a public liability policy. At the start of the year, your bucket is full with a pretty healthy-looking $5 million. That's your aggregate limit. So here's where we start, a full bucket. You've got the whole $5 million worth of coverage for the next 12 months. You're feeling pretty secure, right? As you should. But a few months into the year, bam, a customer has a nasty slip and fall accident on your property. It's a serious injury, and the claim payout comes to $1.2 million. And whoosh, that one claim takes a huge scoop right out of our bucket. Just like that, our total coverage for the rest of the year has dropped all the way down to $3.8 million. But it's just been one of those years. A few months later, a second, totally unrelated thing happens. A defect in one of your products causes a ton of damage to a client's property, and that leads to another big payout, this time for $1.8 million. And would you look at that? After only 2 claims, more than half of your annual protection is just gone. You're now left with only $2 million in the bucket for whatever else the year throws at you. Just when you think things have got to get better, they don't. A third incident occurs. Another person has a slip and fall. This one settles for $1.5 million. Wow, our bucket is now basically empty. After that third claim, we've only got $500,000 left to cover us for the rest of the policy year. We are officially in the danger zone. So here it is, the million-dollar question. Literally, a fourth claim comes in, and this one is for $1 million. You still have an active insurance policy. You've been paying your premiums. But are you actually covered? And the answer is a painful, painful no. Your insurer pays the $500,000 left in your bucket, and then their job is done. The rest of it, the other $500,000, that comes directly out of your pocket. Your bucket is empty, and you are completely on your own. Okay, that's a pretty scary scenario, right? So how do you know if you're at a high risk for this happening to you? Well, there are a few key red flags that you really need to be watching out for. So listen up, you're at high risk if multiple claims are just a known possibility in your business. Think if you're in the trades, hospitality, or you run public events. Same goes for high-risk operations, like manufacturing. And here's one people always forget. Check your client contracts. Sometimes they will specifically require you to have a certain aggregate limit. This brings us to the single most important takeaway from all of this. Please, don't wait for a string of bad luck to find out your coverage is too low. You need to look at your policy with this new perspective and ask yourself one simple question. It all comes down to this. Is your bucket of money big enough to survive not just one incident, but a truly bad year? Because once that bucket is empty, the financial fallout is all yours. Go check your policy right now.